I think it's been a disappointing period. There's no question about that. And part of it is self-inflicted. The narrative, I think, was pretty badly mismanaged, where investors sort of program themselves to just oversimplify this into being a risk-on asset. And when you look at Bitcoin and its fundamentals, that doesn't really make any sense. Bitcoin's drivers are actually, in many cases, inverse to what drives other asset classes. So this idea that you just trade it like a risk-on asset, and if NASDAQ's up, you should buy, and if NASDAQ's down, you should sell, has never really made a lot of sense. And to the extent that Bitcoin is a diversifier and a potential hedge, it's incredibly attractive for institutional and really all portfolios. But if it's not, then the case to hold it becomes a little bit harder, particularly in a world where AI has shown such phenomenal growth and progress. That's sucking the oxygen out of the room from really all manner of other asset classes, but it raises the bar in terms of the threshold conviction that one needs to have to make allocations to other technology plays.
Hey everybody, Tyler Rowe here with the Bitcoin Treasuries.net podcast alongside my co-host, President of Bitcoin Treasuries and the Bitcoin historian, Pete Rizzo. And we've got a special guest today representing the world's largest asset manager, where as global head of digital assets at BlackRock, he led the launch of IBIT, the iShares Bitcoin Trust, which became the most successful ETF launch in the history of Wall Street and one of the largest Bitcoin vehicles on the planet. He's now one of the most closely watched voices on how the world's biggest institutions think about Bitcoin. Robbie Mitchnick, welcome to the show.
Thanks for having me on.
You got it. So, Robbie, IBIT, we got to start there. By most measures, it's the king of ETF launches in all of history. It launched, 2.5 years in now, January 2024. It was widely called the most successful launch in history. Let me run over some of the beats here. It was the fastest fund ever to $10 billion in assets, which took, merely 7 weeks. It was the fastest to $50 billion. It holds nearly 800,000 Bitcoin. The AUM peaked at 74 billion during the last Bitcoin bull run in mid-2025. It's traded the title of the world's largest public Bitcoin vehicle back and forth with Michael Saylor's strategy. And, I think probably in this next leg up in Bitcoin's next bull market, it's going to clear 1 million Bitcoin and 100 billion in assets pretty easily. So what has surprised you 2.5 years in about the response to IBIT and who's actually allocating to it?
Yeah, well, I like your predictions there. It sounds good to me. It's been an amazing journey, obviously. It's sort of been a tale of two parts. The first 2 years were extraordinary and record-setting, as you note. 2026 year-to-date has been a lot choppier, but certainly the upside and the strength of inflows in the first 2 years massively dwarf the outflows that we've seen in 2026 year to date. Just to give you a sense of that, 2024 was around 30 billion in inflows, 2025 was around 25, and 2026, as choppy as it's been, is 2 billion in outflows. And so there's been a lot of sort of drama and attention, et cetera, on what's happening with the Bitcoin ETFs. We're seeing outflows all of a sudden. It's still pretty modest in comparison to the potential for inflow gathering that these have consistently demonstrated through both bull and bear markets, by the way. This is the first drawdown where we did see meaningful outflows. But even, Q4 of last year, post the October 10th meltdown in crypto, IBIT was seeing inflows. So it's had that resilience, and I think we're optimistic that on a longer term basis, we'll continue to see growth in adoption, and a lot of that will come through IBIT and the other ETFs.
It's official. The Bitcoin Treasuries conference lineup just dropped. Grant Cardone, Adam Back, Eric Weiss, the man who introduced Saylor to Bitcoin in the first place. Plus, the CEO is actually running the treasury companies, and the macro voices calling out where the institutional capital goes next. 10 confirmed speakers, 1 closed-door room, September 28th in New York at 2nd. Save 10% on tickets today by using the code SECOND. Reserve your seat by scanning the QR code on the screen or visit bitcointreasuries.net/conference. We'll see you in New York.
Robbie, I got to jump in here, ask, you mentioned the drawdown. Curious about the investor profile. Is it changing? Do you see from the data that maybe Bitcoin's attracting a different investor now, 2 years into these products?
Yeah, there's been a sort of steady evolution over the history of this. When it first launched, it was 80% end investors direct. And quarter by quarter, that mix has shifted to be more institutional and more wealth advisory, where today it's about 50% end investors and about 50% insti and wealth. And part of that's been supported by just a steady progression of approvals that this has gotten on the largest bank wealth advisory platforms in the world, and non-bank wealth advisory platforms too, of course. I think a lot of people don't realize that that took, in the fastest case, about a year for the first large platform to get to be able to approve for advisors to put their clients in IBIT. And many of the largest are still coming through, and they're really pretty indifferent to price direction. I think we've had probably first half of 2026 been the strongest couple quarters for new approvals for wealth platforms. So they're not too focused on short-term price moves. So that's a big catalyst. One thing that I think is often a misperception is this idea that when you see big outflows, it must be end investors fleeing. And actually, that's not really the case. What tends to happen is the fastest, shortest term money in these products is actually hedge funds running the basis trade, which at any given point in time is kind of plus or minus 10% of the assets. When the basis trade is attractive, it gets to 10%, even maybe slightly higher. And when that unwinds, a lot of that money comes out. So on any given day, we've actually seen lots of instances where end investors are buying dips, where other institutional investors are accumulating in bear market windows, and the outflows are a little bit exaggerated by that hedge fund effect.
The hardcore Bitcoiner is known as a hodler who, just holds on to their Bitcoin and, they're not selling at the first sign of trouble. And, I'll put a challenge to, maybe the legacy Bitcoin holders that the holders of IBIT maybe have been even more convicted in their investment, given that we've seen a big drawdown in Bitcoin's price and the relative outflows have remained pretty low. Do you agree that the typical IBIT shareholder maybe even more like convicted in the price performance of Bitcoin long term?
I think there's a lot of evidence for that, actually. And when you look at what's happened since the peak at that new all-time high in October of 2025, IBIT was right around 99 billion in assets at that point. Today, it's right around 50. And of that drop of 50 or so billion, 48 is the price of Bitcoin and 2 is outflows. So it's been very much a hodler type investor base focused in the ETFs. I think the market is sort of segmenting where those who are more short-term focused, more speculative, are using either crypto exchanges directly or increasingly perps. And those who are buying this as a long-term investment tend to favor the ETFs, and that's what we've seen.
Before we switch over to talking about, obviously, BITA launch, talking about now about IBIT and just BlackRock's entrance into the space over the last couple of years, wanted to address sizing in Bitcoin portfolios, BlackRock coming out with a 1% to 2% allocation. This was a big deal for folks in Bitcoin, really validating to the asset class. A couple of years in on that recommendation, is there a conversation about that internally? Are folks still getting used to the idea of a 1% to 2% Bitcoin allocation in portfolios? Where do we go from this recommendation? Robbie?
No, I think it's pretty uncontroversial at this point. The teams that have been using that allocation as a guidepost continue to do so, and they have flexibility to dial it up and down within that range. And, contrary to how a lot of historical Bitcoin trading activity happened, which was people tend to buy after runs and sell after sell-offs, the investors here, the investors we talk to at a lot of our institutional clients, think about it the opposite. One of the big institutional holders in IBIT, they built a toe-hold position of a few $100 million in 2025, around 90 or 100K. and they said we would like to get more, but we really needed to go below 70. That's really where we're looking to come in and buy more. And indeed, they did accumulate on the dip. And so that has had a stabilizing effect on the volatility in Bitcoin. The more actors like that come into the market. Now, for better or for worse, the growth of perps has been an offsetting fact that has amplified the volatility in Bitcoin. So you're not actually seeing as clearly the impact of this sort of institutionalization of the Bitcoin investor base because there's that offsetting force of perp growth for now, but it's there.
I want to talk about something that comes up in almost every conversation I have with Treasury executives. They get the Bitcoin thesis, they see the macro case, but then they walk into a board meeting and the first question is, who's holding it? Are they regulated? Are they insured? Can we audit this? That's where BitGo comes in. BitGo is an OCC-regulated national trust bank. That means they operate under the same federal oversight as the institutions your board already trusts. Your assets are held in segregated trust accounts, never commingled. They're secured in 100% cold storage with multi-signature architecture. If you're building a case for Bitcoin on your balance sheet, BitGo is the custody partner that turns a board conversation from why into when. Visit bitgo.com/Bitcoin-Treasury to connect with their team.
It's the best kept secret known by every true Bitcoin OG. CoinKite has been building the gold standard in private key security for years, and they just raised the bar again. The Cold Card Q is an absolute powerhouse for serious Bitcoin treasuries. We're talking a full QWERTY keyboard, air gap protections, and it's built for maximum security. The brand new Cold Card MK5, it has a massive Gorilla Glass screen and new NFC functionality for an even more seamless experience. So if your business is large or small, there's a cold card for you. Head to store.coinkite.com and use the code 6BT at checkout for 6% off. Stop cutting corners on your Bitcoin treasury. You wish for it. Bitcoin is finally on sale. And if you're sitting on BTC and want liquidity without dumping your stack, Arch Lending can make it easy. You can get USD or USDC in minutes, and your collateral stays in qualified custody. They never rehypothecate your assets. As your assets move up and down in value, you can scale your credit line instantly or pull the collateral back when the market runs. If you need help, you get real humans 24/7, not bots. This is Arch Lending. Simple tiers, public pricing. You can check them out at archlending.com.
Yeah, I've got to ask too, you've been talking to investors for years, about the demand for this type of product. Now, I'm sure this, product was in the works for a long time before you finally got approval in 2024 and the regulatory hurdles were kind of cleared there. Were you and the team still surprised at how much demand has come in to IBIT and into the secondary products?
Yeah, I mean, certainly I was a big believer in this. We as a firm viewed it as an important opportunity to solve a problem for a lot of clients that were looking for efficient, turnkey, trusted access to this. But I don't think anybody had on their board that it would be 50 billion basically after a year. And so it's continued to be an amazing story, and we're excited about some of the follow-on opportunities we have too. The European version of it has done exceptionally well for that market. It's a smaller market, but it's had positive inflows every single month since it's been launched, including through these drawdown cycles. And now with BITA, BITA, the product that we launched in June, we've also been quite positively impressed by the response.
Yeah, speaking of BITA, Bitcoin's historic volatility, its lack of native yield have kept, probably a lot of conservative investors on the sideline who, might be interested in some Bitcoin exposure. So was BITA specifically built for that type of investor who never would have touched the spot Bitcoin product, or someone else?
Yeah, exactly. We think of it as primarily something that provides an interesting new vehicle for investors who otherwise have been interested in Bitcoin, but hasn't quite fit their needs and what they look for. And it's solving a couple of things at once. It's providing income. In the case of BITA, the way we designed it, substantial income targeting high teens sort of yield. And it's cushioning the downside and the volatility. And so when you put that together, we actually think that's a pretty attractive package. Now, what's been interesting is that we designed this primarily with new sort of on the fence Bitcoin curious investors in mind, but a lot of large Bitcoin holders have actually expressed interest and specifically have expressed a desire to be able to in-kind some of their Bitcoin and be able to hold BITA. Now, that is a little bit more complex and not as clean from a tax perspective as the in-kinding of Bitcoin into IBIT, but it shows you that, if you're sitting on a ton of Bitcoin, actually for a lot of those folks, it's kind of attractive to think, I'm going to give up a little bit of my upside. So it's targeting that you keep 70%-ish upside in Bitcoin. Give up a little bit of that upside, which I still, might have really high conviction in, even at 70%, and in exchange get a very juicy annual yield. That's been attractive. So I think this is resonating with even more folks than we thought.
I want to drill into where BITA fits into the toolkit. With Bitcoin Treasuries, as Tyler mentioned, we have a lot of sophisticated investors. They're really looking at Bitcoin exposure across the public markets and the capital markets. Do you think this maybe puts pressure or changes the nature of the Bitcoin Treasury trade, this wrapper, right? This idea of yield on Bitcoin. You do have a lot of operational governance complexity with the Bitcoin Treasury model. How do you look at it? Is it a complement to that? Is it in opposition to that? Where do you think it fits in the field?
I think it's just pretty different. I don't think there's going to be a ton of overlap. Obviously, at a headline level, some of the products that are out there in the Treasury category have kind of low teens yield, and BITA has target high teens yield. So in sort of a purely superficial sense, there's some similarity there, but the way that is delivered is very different. And so the ultimate economic exposure that an investor is taking is quite different. It's pretty straightforward trade-off that investors are making when it comes to BITA. They're giving up a little bit of their upside in Bitcoin in exchange for being able to generate that sort of yield. And really what it's doing is making the volatility of Bitcoin actually work in your favor, right? You couldn't generate a yield that strong with upside retention that high on, say, S&P 500 because the volatility's not as high and therefore the option premiums are not as attractive to write.
Yeah, I think this is a product that, Bitcoiners have been looking for a long time. If let's say a year from now, BITA's working as expected, maybe it'll blow through your projections internally as well. What would that tell you to see BITA be a real success about the future of structured derivative products around Bitcoin?
Yeah, I think it would be a great indicator, and there's certainly some early signs that suggest there's a lot of desire for that. Bitcoin's got some really unique properties in terms of its payoff curve and return distribution, right? Historically, it's been a uniquely positively skewed asset, meaning the right tail of returns is fatter than the left tail. There's not a lot of assets for whom that's true, and it may be counterintuitive to some, but equities, debt, things like that are left skewed assets, meaning basically the crashes, the drawdowns are more severe than the big upside moves. Obviously, equities have been a phenomenal investment asset class for a long time and will continue to be the bedrock of portfolio construction. But even they are negatively skewed. The few things that actually are positively skewed is basically Bitcoin and gold historically. You might say, well, that's a great attribute of it, sure, but you also might say, I'm willing to do some tailoring, some repackaging of the payoff profile to create something that's a little more suited to the rest of my portfolio and how I think about risk and return and volatility in my circumstances, right? And there's going to be some broad commonalities of where people want to do that, and there'll be some places where people want to do that in a very bespoke, customizable way, and that will also be possible.
Before we get too deep in the weeds, I do want to help people follow along who may be new to the BITA product. And I got to ask the classic question. People see it out there on X and other social media. It's where does the yield come from? How does the product actually generate that return for the end investor? And can you contrast it to some of the models out there?
Yeah, it's pretty straightforward, actually. It holds as a baseline a combination of Bitcoin and IBIT. And then it writes calls on a monthly basis at the money, targeting, roughly 30% of the notional that it's writing calls against. And that is producing that target mid-high teens yield on an annual basis. So the result is that you're in any given window, if Bitcoin is down, we would expect BITA to outperform IBIT. If Bitcoin is flat, we would expect it to outperform. If Bitcoin is up modestly, we would expect BITA to outperform IBIT. And if Bitcoin's up massively, then BITA would underperform IBIT. And in that case, you'd have rather just held Bitcoin or IBIT directly. But we think, for a lot of investors, they're going to say, I'm actually okay with that. I'm winning in a bunch of scenarios. And the scenario where I'm not winning, I'm still winning because, Bitcoin is up a lot and I've done well, maybe just not quite as well having been in BITA versus if I just owned it outright.
I think a lot of things changed in 2024, 2025. We got a lot of additional regulatory clarity in the United States. And traditionally in crypto markets and Bitcoin markets, a lot of the derivative trading happened offshore on crypto native exchanges. And now that you've launched your products, you've got a structured covered call product with BITA. You've got IBIT is basically the dominant player now in Bitcoin options. How has that been meaningful, and how do you think that can shape the future of Bitcoin derivatives?
Yeah, well, it's been really important for us. We couldn't really do a product like BITA with confidence and know that we could scale it to be a many billions product while still being able to deliver good liquidity and execution quality without a really robust IBIT options ecosystem. And so the fact that we have that has been critical. So there's a natural synergy between IBIT's success, its scale, its tremendous liquidity. IBIT versus USD trades more than any BTC USD pair in the world. IBIT options are now larger and more liquid than any Bitcoin options market. And so all these things are sort of a reinforcing flywheel that allows us to deliver really efficient exposure solutions to clients.
Drill it down maybe with a more specific question. Folks, we mentioned the Bitcoin treasury companies and that model. Obviously, people can buy direct equity exposure for those products. The preferred equity products really are something different, paying out some sort of dividend. How would you compare a product like an STRC or SATA to a BITA, and which type of investors might favor a BITA over those options?
Yeah, I really do think they're in different categories, and it's pretty different investor types trying to accomplish different things. We haven't had a single client conversation where we've been asked to do like a side-by-side comparison. So I get obviously that there's the sort of superficial similarity around both carrying yield, but the way that's created and the sort of risk-return, upside-downside payoff profiles are pretty different.
Yeah, I'm curious of maybe your high level take on, you know, what Michael Saylor's done through, the other, giant public equity that holds a lot of Bitcoin. Famously, as our viewers know, 6 years ago, he jumped in on this Bitcoin strategy and has been, really trying to mainstream Bitcoin adoption. And to see asset managers like BlackRock, jump in there has to be like exciting for you. I'm sure it's something you've worked on for a long time. But what's your take on, how Michael Saylor has kind of attacked capital markets, and what does it mean for the larger Bitcoin ecosystem?
Yeah, well, I would say, my experience there is more at a personal level where, I think Michael's been a great leader and a great innovator, who's, had a lot of success in the space, obviously, and, has helped tell the Bitcoin story. From a, professional or BlackRock standpoint, we tend to be playing in just sort of different parts of the capital markets and investor ecosystem. So, don't have a lot of instances where we kind of overlap. Obviously, I cheer for his and their success, but that's kind of about it.
Really cool. And, famously, Larry Fink at BlackRock did evolve on, Bitcoin as having a place in the typical portfolio. You must have had a hand in that, Robbie. Tell us what that was like to see, BlackRock say, okay, Bitcoin's a real asset. It's here to stay. What were some of the key moments? Was there a specific moment when it's like, okay, BlackRock is a core asset that belongs in, many portfolios, or was it a cascade of things? Was it Bitcoin maturing? The longer it's been out there in the market and been resilient through the ups and downs. Tell us how that IBIT came to be,
Yeah,
part of the suite of products.
sure. Well, it's a number of things happening over time. Certainly the steady and growing signal of client demand and really client frustration with not being able to take exposure through an efficient vehicle, and some of the pretty suboptimal outcomes that our clients were getting instead through kind of alternative proxy exposures that they had to take, instead, including a bunch of different vehicle types. I think the political and reg environment, even long before this administration, was clearly moving in a direction of recognizing that this is a technology that was important in an asset class that was here to stay. And the infrastructure that supported the ecosystem, year by year, particularly post the 2020 and the big influx of financial capital and venture dollars that came into the space, helped make this more institutionalized. And so all those things came together. I think there are a couple episodes that were also important in terms of Bitcoin outperforming in major global geopolitically disruptive episodes that reinforced this idea of what it could be as a diversifier in portfolios and a potential hedge against some of the left tail risks that exist in investors' portfolios by virtue of the fact that it's this emerging global monetary alternative that exists independently of any one country's political, economic, fiscal, monetary risk factors. And so when you put all that together, great credit, I think, to the willingness to be open-minded and to continually take stock of evolving facts on the ground to shape a strategy and what we had conviction to do.
Want to zoom in on the current market cycle as we kind of maybe zoom out and talk a little bit more macro. There was a hope in the Bitcoin community, certainly, and I think also externally, that institutional involvement would dampen Bitcoin's volatility, right? That maybe you wouldn't see the kind of historical cycle performance. You talk about those 80% drawdowns, those 70% drawdowns. Right now, 50%-ish drawdown from peak. How do you think about how that market has performed, how it's held up against expectations?
Yeah, I think it's been a disappointing period. There's no question about that. And part of it is self-inflicted. There's no question. I think if you look at there's been 5 cycles now in Bitcoin's history. And of course, in each cycle, it's come back stronger than the last and made new all-time highs. But a lot of the things that cause these cycles to end are self-inflicted, right? In terms of approaches to risk, to a level of recklessness and financial math that doesn't make sense, and in some cases, as in the last cycle, outright instances of fraud. Thankfully, we haven't seen any of that in this cycle. Knock on wood. But here you've got a dynamic where the narrative, I think, was pretty badly mismanaged, where investors sort of program themselves to just oversimplify this into being a risk-on asset. And when you look at Bitcoin and its fundamentals, that doesn't really make any sense. Its drivers, I mean, if we could think of a world where, we had universal prosperity, peace, law and order, democracy, property rights, human rights, etc., that would be an incredible environment for most asset classes on the planet. I think it would be really, wouldn't be a lot of reason to hold Bitcoin in that state of the world. And so Bitcoin's drivers are actually, in many cases, inverse to what drives other asset classes. So this idea that you just trade it like a risk-on asset, and if NASDAQ's up, you should buy, and if NASDAQ's down, you should sell. has never really made a lot of sense. But once it gets programmed in, and then you layer it in with a lot of leverage and the growth in perpetual futures, you get a recipe for that. And so, October 10th was one episode of that. We saw it again in late Jan, early Feb with that other big move down. And that starts to undermine a little bit the diversification thesis to hold this. And to the extent that Bitcoin is a diversifier and a potential hedge, it's incredibly attractive for institutional and really all portfolios. But if it's not, then the case to hold it becomes a little bit harder, particularly in a world where AI has shown such phenomenal growth and progress. That's sucking the oxygen out of the room from really all manner of other asset classes. But it raises the bar in terms of the threshold conviction that one needs to have to make allocations to other technology plays.
If you're building or managing a Bitcoin treasury, you need institutional infrastructure to match. BitGo is the digital asset backbone trusted by thousands of institutions worldwide, offering regulated custody, OTC trading, financing, and settlement all under one roof. They're now a publicly traded company on the NYSE and hold a federally chartered national bank license from the OCC. For Bitcoin treasury companies, this is the infrastructure layer that matters. Learn more at bitgo.com. CoinKite has been building the gold standard in Bitcoin private key security for years, and they just raised the bar again. The brand new Cold Card MK5 brings a massive Gorilla Glass screen and new NFC functionality for a more seamless experience. The Cold Card Q is an absolute powerhouse for serious Bitcoiners, with a full QWERTY keyboard, air-gapped, and built for maximum security. Whatever your setup, executive, Bitcoiner, Bitcoin Treasury, there's a cold card for you. Head to store.coinkite.com and use code 6BT at checkout for 6% off.
The tip is here, and with it, you might be thinking, is it time for me to borrow against my Bitcoin? Enter Arch Lending. They're building the most transparent borrowing experience in crypto. We're talking industry-leading rates from 8.49% when you borrow against BTC, and you receive USD within minutes. Your assets stay protected with qualified custody. There's no rehypothecation, and verifiable segregated addresses are used always. As your collateral grows, you can unlock more liquidity, adjust your line anytime, and extend your term with a single click. And with 24/7 white glove support, you're never going to feel like you're on your own. Arch Lending, simple terms, public pricing, market-leading rates at every size. You can learn more at archlending.com.
Maybe let's stick with that for a second. How do you think that we get back on the messaging track as a community then, if you think maybe we aren't evangelizing as sharply as we could be?
Yeah, it's a hard question. I think that there's a lot of really smart people in the Bitcoin space and who see this and believe it. And I think it's important to have these discussions in a really robust way. And a part of it is, if you're running a business that's focused on trading volumes, it's hard to get people excited to trade off of a pretty limited news flow that's very long-term in nature, right? Like, realistically, there's only 2 or 3 things a year that actually probably impact the long-term fundamentals of Bitcoin. That doesn't create a lot of news flow. Whereas if you can point to whatever's happening anywhere in the world in any economic factor or equity market or interest rate market or otherwise, that gives a lot of content to sort of keep the machine running. And so I think we have to recognize that. I think people that are thoughtful in the space, and there are many of them, ought to have the voice and the presence in the discussion and start to reprogram that. And I do think that when you have a big washout like we've had, it helps too, right? Because some of that sort of short-term speculative levered type money exits and pursues other things. And so what you're left with is that larger base layer of the Bitcoin market that is more long-term fundamental buy and hold in nature.
I think you nailed it on the head as well when you said that, AI has been sucking a lot of the oxygen out of the room. There have been capital raises from Google, from Oracle, various, large mega cap companies. You've got the SpaceX IPO that's attracted a lot of capital. But the debasement trade is clearly still on. Is the deficit narrative, the deficit story globally, going to be the dominant story that kind of gets Bitcoin's price action back on track? Because I think that's the overarching, big story in Bitcoin throughout the years. However, this last kind of epoch has been the Bitcoin IPO moment, when you've had strategy and Bitcoin treasury companies coming in, and of course, IBIT being launched and giving a public market vehicle. But what story is in store for Bitcoin that does get price back on track?
Yeah, I think that's it. It's that plus a greater understanding of the connection to AI, which I think is underappreciated. So first, the debt and deficit piece, that's an issue in the US. It's an issue in many countries around the world. In this new AI era, there's potential for that issue to become greatly amplified, right? As you think about transitions and potential greater pressure on government budgets to support populations. So I think that that dynamic has certainly not gotten better in the U.S. It's just become less of a hot topic, and it's true in many countries around the world as well. And it's only a matter of time before that comes back to the forefront. And I do see that as a catalyst. And the second piece is with AI. Digital assets is certainly not the same magnitude transformative force that AI is. Frankly, I don't think anything is. We've really never seen anything like this. But there's an important role that digital assets have to play in the AI future, right? And just at a very simple level, if we think about what AI is, it's machine native intelligence. And what digital assets are is machine native money. And so there's a much more natural synergy in terms of the usage of digital assets, both in a store of value and a medium of exchange sense, in a future AI-centric economy, particularly one where AI agents play a really material role. And that narrative, I think, has only just begun to enter consciousness.
I got to press a little bit on the, I know we're talking macro now, but the inner Bitcoin kind of cycle dynamics. Kathy Wood out there saying, she believes this 50 to 60% drawdown for Bitcoin would be a bit of a victory, right? It's improvements on historical performance in some regards. Generally, those big kind of collapse moments have happened, though, as you noted, when either there's, some sort of fraudulent moment or infrastructure failure. And I think that's what a lot of folks are looking at when they're looking at the market right now, wondering whether we have bottomed out. The infrastructure failure part, do you see that as a probable concern at the moment, given how far the market has come?
Not particularly. I think that with each passing year, with each passing cycle, the quality of the actors in the infrastructure has improved and become more credible. And so, to make this point really starkly, think about the second Bitcoin cycle, which peaked in 2013 at just over $1,000, then collapsed by over 80% in 2014. Mt. Gox was the one exchange that existed, right? And its implosion is what ended that bull market. Well, compare what we had then with Mt. Gox, which was truly a fly-by-night operation, run by a few guys offshore, to the evolution over subsequent cycles and the types of players that we have around custody, exchange, prime brokerage, et cetera, today. And it's night and day. So, obviously anything is possible in any industry at any time, but certainly this industry has come a long way.
Yeah, it certainly has. Now, thinking beyond spot Bitcoin, beyond now BITA, we're gonna see in the coming months, how successful that product is, and I think there's insatiable demand for that type of product that maintains Bitcoin's upside and offers some really attractive returns. What's the next roadmap? You mentioned that the preferred equity products of Bitcoin treasury companies are, a different animal entirely, attracting a different investor base. But those products like STRC have been included in a lot of preferred equity indices from a lot of companies. Is there? I consider those like a credit product in nature, and I think Michael Saylor would definitely agree. Is there a similar product that BlackRock can go to target that segment of investor? And what does the broad roadmap look like in the future? And you can touch on ETH as well. You've got your ETH products, which have some native stake yield, but walk us through the broad roadmap.
So there's a temptation when you launch a product or a couple products that are massively successful, and ETH, which we did in July of 2024, was also incredibly successful in its own right. It looks small in comparison to IBIT, but in comparison to just about every other ETF in history, it was also tremendously successful. There's a temptation to then go and do lots and lots more. And we've very deliberately resisted that temptation. We think there are more opportunities to provide solutions that solve real problems for clients in this space. And so what we did with ETHB by delivering a version of Ether that has staking in it, we thought was one of those, and that's been quite successful, having launched just earlier this year. And what we've done with BITA here is also an example of that, solving an unmet need. But we haven't, as you'll notice, done 8 or 10 or a dozen additional follow-on products or assets. We need to have a really high conviction, not just that there's a market for it, that it would be commercially resonant, but also that what we'd be delivering clients, we could do that with a straight face and a belief that we've offered something that's a credible long-term investment opportunity. And so you'll continue to see that discerning approach from us, and it'll be the same kind of gradual measured pace of additional follow-ons.
So you guys at BlackRock have been close to tokenization as well from the start. How real that's been a topic within the crypto community for a long time. There's this $1 trillion of on-chain, market opportunity out there, real-world assets, the tokenization of equities, and more. How close are we to that future? And from your vantage point, what does that look like?
Yeah, it's funny because sometimes you will hear people try to separate these two as just different ideas, right? And I think it's more common you hear that in traditional finance circles, that there was a time when it was bullish on blockchain, bearish on Bitcoin, and then some modern incarnation of that is bullish on tokenization, bearish on crypto, and that doesn't really make a lot of sense, right? Because ultimately these are pretty inextricably linked as concepts. And so we're bullish on both, on all parts of the ecosystem that are showing the material traction that they have. And in the case of tokenization, I think it was actually a slower start for a number of years versus where the hype was. That now we're actually starting to see the green shoots of real growth and adoption. The first big breakthrough was tokenized money funds that solved a real problem in terms of not having to make a trade-off between yield and liquidity by being able to have a tokenized money fund and a stablecoin interoperate on a 24/7 real-time basis. So that was a really powerful breakthrough, and I think we're just getting started in that category. And then you've seen, obviously, this massive growth in tokenization of stocks and ETFs. And so we're excited about that too. There's a lot of energy around the ecosystem going into that. I think in some sense, this bear market is a helpful catalyst there, because it's causing people to build more deliberately and to put real energy behind making this a reality. So you've got, hundreds of millions of users across the crypto ecosystem who maybe for the first time now are going to start to get access to a much broader portfolio of asset classes in a traditional sense. I don't see that as a bad thing for crypto at all. I see that as a really healthy thing for these users and for the ecosystem to become part of a larger financial whole.
As we wind down here, I think, it helps to zoom out. There's been a big question. Obviously, I've been in the industry for a long time, close to 15 years, of when it will sort of cross the chasm and become an everyday product, something that touches people's lives on a daily basis. How do you see that playing out? Obviously we're closer to that than perhaps we ever have been, but how does that story evolve from here?
Well, I think stablecoins are part of the leading edge of that in all likelihood, because there's significant advantages, particularly anytime money is moving across borders, that stablecoins can play. And so we've just seen stablecoins get to 300 billion in market cap, despite barely scratching the surface of use cases outside of crypto trading and DeFi. Now, I think with Genius and the maturation of this industry and players like Circle and others who've been leading, that you'll start to see this enter cross-border payments in a retail sense, enter corporate multinational liquidity management and cross-border payments, enter capital market solutions alongside tokenization. And those are applications that on a sort of day-to-day basis become more real and tangible that a broader swath of the population actually touches.
From your vantage point, Robbie, what has to be true over the next few years for Bitcoin to, transition, like Pete said, into this core institutional holding? You guys, again, famously have recommended, in the past 1% to 2% allocations. You've got financial advisors who are recommending. I've seen 5, 10%, 15% recommendations of Bitcoin in holdings. There's family offices I've heard that have really high allocations to Bitcoin. Of course, there's your traditional hodlers who are, 100, 110% invested in Bitcoin. But how do we see this happen into a core institutional holding, and how do you onboard everybody from your your 20-something investor to grandma and grandpa?
Sure. Well, I think the catalyst has to be one of these various risk factors or disruptive threats that face the rest of the traditional asset class base occurring, and Bitcoin reminding people of its value proposition as a monetary alternative that exists independently of the political, economic, fiscal, monetary systems of any one country, right? And so whether that's a renewed focus on debt and deficits like we've talked about, other geopolitically disruptive events, we've seen a handful of these over time, whether it's conflict between nations, concerns over stress in banking systems, political upheaval in important economies and parts of the world. These have at times been catalysts to Bitcoin in the past. I think that memory of those has faded a little bit and been overrun partly by the sort of risk-on trading mentality and narrative. But one or more of those episodes coming back and a re-reminder of the important role that we believe Bitcoin can play as a diversifier and a potential hedge in portfolios, then I think the conversation shifts from, is this too risky for us, to actually, is it risky not to hold any?
One more real quickly, Robbie, before we wrap. So for the Bitcoiner in our audience who might be still wary of Wall Street getting too close to their asset, what would you say to them?
Well, these ETFs have been incredibly successful, but they're still a very modest part of the overall Bitcoin market. And, Bitcoin is not controlled by anyone. It's an incredibly decentralized asset that's part of the huge appeal and differentiation that it has. So I think that actors like us and other asset managers and banks that have taken an interest in this space and worked to develop products, I think they've made the space stronger, more diversified, and have helped make this accessible to more investors. So I hope people appreciate that that's been a force for good ultimately for Bitcoin.
Great stuff, Robbie. This has been a treat for Pete and I both. And one thing we have all our guests say before they leave, Robbie, is stay orange.
Stay orange. Thanks for having me.
Love it. Thank you. Ladies and gentlemen, Robert Mitchnick.
Yeah, we appreciate everybody watching, tuning in. Of course, if you're on YouTube, smash the subscribe button and press that like. We'll see you upcoming at the Bitcoin Treasuries Conference, of course, in September the 28th in New York City. You can go to bitcointreasuries.net/conference to find out more. Wall Street and Bitcoin coming together, the conversation becoming sophisticated. We'll see you there. Get your tickets.